Rick, let's talk about the election. We're only a couple weeks out now. A headline in the FT this week that got some attention. Your CEO, Mr. Larry Fink, the outcome of the U.S. election really doesn't matter for financial markets. What do you think? You agree with Larry?
Oh, he's a smart guy. I would say, listen, I mean, I think there's a short-term and long-term dynamic, or intermediate-term dynamic. I think in the short term, markets are going to gyrate. There's no question about that. There are all sorts of every meeting I go to, people want to describe this policy versus another. What is corporate tax policy? What going to be? What are tariffs? What are we going to do across broad taxation, corporate, personal, et cetera? So. Near term, I think is going to be a reaction. I think what Larry's very right about is at the end of the day, depending on what the Senate looks like, et cetera, policy probably won't radically change. And that at the end of the day, if you're invested in the right businesses, the right companies, the right rate structure, I've said this for years, like markets and the economy are incredibly resilient to policy, unbelievably resilient to policy, good policy, bad policy, market economy, this market, U.S. economy particularly, incredibly flexible, energy independent, technology proficient, education oriented. It's pretty hard to run against it.
Well, and Rick, as we've talked about before, you kind of, have your two different hats as sort of that long-term secular investor hat, and then you have your trader hat that you also put on, where you try to be a little more tactical in the short term. Is there anything you're doing leading up to the election, and is it changing the closer that we get in order to sort of position around it?
Yeah, some of the big ones are we've brought down a bit of our interest rate exposure, but we bought some front end on the back end of the curve, on the back of this backup that you've seen in interest rates. We're running a lot, we're running moderately long equities, but gosh, the volatility in the equity market is to buy volatility in the equity market is crazy cheap. So we've added a lot of convexity to the portfolio through equity. So what happens is we de-risk pretty quickly, and then we're in. For that comment before, in stocks, I like these big durable companies with big cash flow models that are almost regardless of policy, will keep doing their things. Tactically, I don't love like big cap versus small cap. Like I like the big, generally in big cap, the ones that are in data generally, and we're doing nothing but growing that. We love income. We launched this ETF called BINC that's done pretty well. It's gotten a lot of inflows. Income is where people because rates are where they are, and I would still say the Fed's still got to cut to get on the right curve relative to inflation. You can clip 6.5%. 6.5% income without taking a lot of risk. You don't have to go out the yield curve. You don't have to go into exotic emerging markets. But down the fairway, parts of high yield, securitized assets, investment grade credit, Europe, where it's great to be a lender in Europe, where the yields are high relative to growth. So I just think it's just let's keep, and we keep optimizing what we're trying to own in terms of income. But that to me is a trade, and it'll keep working.
People love clipping that coupon. Rick, thank you so much. It's always great to see you. I appreciate it.
Thanks, Julie. Thank you.
And by the way, we look forward to talking with Rick even further. That's at our Yahoo Invest Day, Yahoo Finance Invest Day, Tuesday, November 12th. It is our big annual conference. Rick will be just one of the fabulous guests that we and you will be hearing from on that day.